Welcome back to another episode of the Lone Star Capital Podcast. I am your host, Craig McGrouther, the Director of Business Development, alongside CEO Rob Beardsley. Very excited to be together in Phoenix, in my humbled abode, my backyard, as a matter of fact. It's very exciting. The weather is perfect. This is the week of Raise Fest. I was doing God's work today, grinding, and on the golf course, as one does early in the morning. Are you still in your camera, you think, still, after moving like that?
No, I think I was supposed to move earlier. I just forgot.
Okay. Well, do we want to check that?
Yeah, you
check
go
that
check.
before we
You
go
go
too
check.
long into this one. Yeah. Yes, we're good. Yeah, great day on the links, doing God's work, doing the gritty work. You know, someone has to do this work. Someone has to be on the golf course and schmooze and talk to people and find new partners. And I have to be that guy.
What they say in New York is if you can walk to work in New York City, then that's the American dream, right? You're living a dream.
Right.
But I think in Phoenix, if you can play golf while working, that's the American dream here.
I would concur. I would concur to that one. I wouldn't have it any other way. The goal is to eventually play 72 holes a week. That's what I want to do. Someone has to do it. But in all seriousness, I'm going to start, I think, this summer doing some fun recordings and whatnot and mixing in a little bit of personality, a little bit of travel and lifestyle, and then obviously mixing in some real estate takes there between, add a little sprinkle to it and add another wrinkle to the content there, because saw our buddy Derek getting 50,000 plus views on his Pakistan videos. That's Pakistan. His New Zealand one will probably even do better. So super cool for there. We can see him soon here in Phoenix. But we got a nice show for today. You had some stuff you wanted to talk on, actually, for the agenda here. So let's kind of get into that. So let's start with capital calls on dual tranche. So this is probably pretty complex here and nitty-gritty stuff when it comes to spreadsheets, when it comes to waterfalls and how performance of deals go and whatnot. But let's kind of get into that. It's an interesting premise. It's perhaps if you're really new into this won't make sense. But if you understand how preferred returns work and things of that nature, then preferred equity and all that stuff work, it's more straightforward. But I would love for you to kind of go into that in more depth.
Yeah, so I actually made a very in-depth video on capital calls that just came out today. So I'm back doing my Founders Insights videos, which are just basically me solo in front of a camera, 5 to 20 minutes. And going to try to stick to those videos and provide a lot of value because in the past those have been really popular. So the latest edition was about capital calls, and that has already caused a little bit of a stir on LinkedIn, which is great. It's great to start a conversation. But what I omitted from that video, so basically, yes.
Well, what was the stir, by the way, too? I'm sorry, I'm dying to know.
Well, it's just kind of like, the LinkedIn people, AI bots, like, capital calls are not good. It's like,
sometimes doing them is necessary. Thanks for the insight.
Right, exactly. It's important to have a good business plan before beginning your operation.
Yes,
so, yeah,
thank you, Captain Obvious.
There's a lot of pointless rhetoric going on on LinkedIn. But anyway, basically, if you're interested, I definitely highly recommend everyone to go check out those videos. I'm going to be trying to put out really quality content there and my best thoughts, my latest and greatest. And hopefully I can also circle back and actually make some more I don't want to call it basic content because I don't want to, level it down, but kind of more get out of the weeds a little bit and speak to people who it's not gibberish to and makes sense to. But anyway, what I missed in that video as far as capital calls are concerned are how capital calls work with dual tranche syndication structures, because at the end of the market cycle, call it 2020, 21, 22, and beyond, because it's kind of been here to stay a little bit, are these dual class syndications where there's an embedded or synthetic preferred equity slice. And so that's a lot of words. And to simplify it, basically sponsors started to raise money in two forms. They would have a Class A tranche and a Class B tranche. The Class A would be essentially a preferred equity position that sat senior to the Class B, so they got paid first, and all they received was a current pay. So every month they would get 10% on their money, but none of the upside. So this appeals to the income-driven investor who probably wants some more downside protection. The Class B, on the other hand, appeals to the growth-minded investor because they sit subordinate to the A, and so they have to watch the A get paid their 10% first, and then they get any profit above and beyond what is paid to the Class A, their fixed rate of return. So it's basically adding more leverage to the deal, but in a more friendly way, because it's not like you're adding some third party, scary, preferred equity, mezzanine debt or something like that that has teeth and default rights, remedies, foreclosure, that kind of stuff. So that became really popular because it was a way to essentially financially engineer better returns, and you're kind of slicing the deal up to give different people what they want to hopefully be like a win-win-win. Now, more cynically, you could look at it and say, well, you know, that's sponsors taking advantage of people and they don't know they can't identify the risks of the deal and so on, but that's not for today's conversation.
Going through this under the assumption that people understand what they're getting themselves into. Is that fair for the comments you're making here?
I mean, the comments that we're talking about are basically what's done is done, right? People are in these deals, people are in these structures.
Regardless of knowledge base or not. Yeah.
At this point, the cake is baked, and now there are capital calls being made on these structures, which is kind of beyond the pale. It's something that people never
hope to get into.
Never
or want to think about. You know what makes an investment thinking? Gonna get capital called.
Exactly. When
everyone thinks they're doing a great deal, and these deals are probably also done when the market was hunky-dory, and you probably just made a lot of money, or your friend just made a lot of money from the seed he planted in 2019 or 2018. He or she, I should say.
Nobody ever thought with rents going up 10, 20% the year before that, oh, well, yeah, they'll probably go up another 5, 10, 15% next year, right? So everyone was very optimistic. But anyway, we don't want to go back and, litigate the past.
Yeah.
The point is, with capital calls, it's a very interesting situation because the Class A investor invested into the deal as pref already, thinking that they were in a safe, secured position. Now with a capital call coming in, depending on the way that these deals are structured, the new equity coming in could actually come senior to the Class A, the existing pref, and subordinate that pref. So now the A investor who thought they were in a secure position, who thought they were senior to all the other equity, is now going to be pushed subordinate because people are raising capital calls in these preferred equity structures rather than doing just a straight capital call. And so what are the differences there? I talked about that in depth in my Founder's Insights, so please go ahead and check out that video. But
give the short version of that maybe if you didn't already.
Okay, yeah, so the short version is basically a capital call is where, let's say me and you and 8 other investors do a $1 million investment, and so we all put in 100 grand, right? So we each own 10% of the deal. Now, if you get in a bump into the road, the property's not performing well,
maturity comes up.
You need to make a capital call to keep the deal going, whatever it may be for, right? And let's say the capital call is 50% of your original investment. So now you put in 100 grand into the deal and you own 10% of the deal, right? Because it was a $1 million raise. We're each going to have to put in an extra $50,000 into the deal to meet the capital call, and we'll have put in 150K now, but we still only own 10% of the deal each, right? So we made the capital call just to maintain our ownership percentage. And so that is generally speaking how a capital call works. And if, let's say I didn't want to make the capital call, right? And my original 100K, I'm going to get diluted down. Instead of owning 10% of the deal, I'm going to get diluted down to now what is 100,000 divided by 1.5 million. I can't do simple math in my head. So, it's like 7 and 7%. Right. So you get diluted if you don't meet the call, but it's not like the end of the world. Now, of course, there's different provisions where there could be a penalty dilution rate or all sorts of nastiness, but that's in essence what a capital call is. It's very egalitarian, and it's kind of like, it literally is pari passu, right? Like no one's subordinated to anyone else. We're all just putting more money in to just ride it along together. Now, what's been more popular this cycle is instead of issuing a capital call to investors, sponsors have been doing a preferred equity fund, which actually is smart in a lot of ways. The foremost way that it's smart is that it allows third-party equity to come into the deal. So you're giving the opportunity to investors who weren't a part of the original investment to now actually come in and fund the pref. The funny thing is you would have to frankly be an idiot to do that, because why would you come in as third-party equity not related to the deal at all and save that sinking ship, right? You're only motivated to save that sinking ship if you're on that sinking ship. Otherwise, why would you throw out the life vest to your own detriment? Now, if you're throwing out the life vest and they're offering you a 25% return, then maybe that's a different conversation. But throwing out the life vest to only get an average return when you could just go invest in a totally brand new deal and perhaps outperform, that's when it doesn't make sense for new investors But for existing investors, it makes a lot of sense. So if you can get the third-party equity, it's great because it opens the door to just more equity that could potentially feed your capital call. But the downside of this is the dilution that I talked about and the subordination. Because now the pref's coming in and it's kind of carving out all the existing equity. Now they have to wait in line behind the lender, and now this new pref equity, everyone has to get paid first, and then the original equity is getting paid last, which is basically adding more leverage to the deal, especially if you're talking about a situation where there's a dual class equity tranche where there's an A class that was an existing pref. So you might have like a bridge loan or just a senior loan, and then the A class original pref, and then you have a new pref come in. It's going to be lender, new pref, old pref, and then finally you get paid, which at that point, that's such a long line, you may actually never get paid back. So what's done is done, and unfortunately, that's just kind of where we are today.
Is there any good cases for that, or would you not think that there's any good cases to, do that preferred equity? Because you said for the most part, it's not, a smart thing. Or is your thought for a capital call, would you prefer to do it if it creates a long-term stability? Because I remember you were talking about this, you called me, and I don't know if it was a trick question, but you had an agenda behind the question to see how to answer it. And it was with regard to, would you do and meet a capital call if you believed in the deal and it bought you, a longer period of time, basically a loan modification, an extension to the current deal. Maybe you're going from floating to fixed, and this gives you a tarmac. Maybe it doesn't cash flow, but it saves your kind of current capital and you're reinvesting, and then you live for another day. So what's your kind of take on those two things? A lot of people might be interested in that subject. Does a preferred equity, play make sense to do that? Maybe like a hope note of sorts, right? Or does it make sense to, if you're an investor in a deal, I guess these are different things. If you're an investor coming into an opportunity where you're getting capital called, or would you rather go into a deal in a preferred situation when you didn't initially invest?
So I would say
that was a terribly asked question, so I apologize.
No, that's okay.
I was putting it together.
So the thing is none of this is cookie cutter, and it's all so specific to the deal because not all capital calls look the same, and not all preferred equity infusions look the same. So it really just depends on the cost of capital. But what I will say is that sponsors have the ability to do a great service for their investors by doing these preferred equity raises internally rather than going out into the world and securing a third-party rescue capital term sheet or pref equity investor, because the cost of a market rate pref or rescue capital is going to be a lot higher than what a sponsor, at least a sponsor with good relationships, good reputation, and a strong ability to raise capital, they're going to be able to raise capital internally at a lower cost of capital for that pref than if they go third party. So I like it. I think it's a great thing that a sponsor could do for their investors. We saw it happen even like a year ago or so, earlier in this interest rate regime change, where there was a sponsor in particular who went out, got out ahead of the issue, went to their investors, pitched the deal, explained the situation, and basically, I think was able to raise pref at 12%. And you can ask anyone, to be able to get rescue money essentially, or high leverage pref at 12%, that's really, really attractive.
I mean, that's better terms than normal pref.
Correct.
Yeah, I mean, we
Exactly.
borrowed pref for one deal ever. Oftentimes we get asked all the time, oh, would you take pref? Can I invest in pref? The answer is no. We will get it from our lenders that offer it for a very good rate to lever up the deal in that way. But to get 12% pref is quite impeccable. So good for that person. I don't know who you're referring to in all sincerity, but good for them. I'll ask you off conversation. I think that kind of covers that topic there. Let's go on to the next conversation, which is a thing that you really are loving to nerd out on. And for those who don't know, the company's just really changed over the course of the last year. So what's happened is Rob is in the CEO position. He's not just the founder anymore, running just the capital market side of things. He's running really, I would argue, kind of overseeing every function, but specifically you are in the weeds on asset management, construction management, property management, hirings of all sorts, right? I'm sure I'm missing a role or two, obviously visionary things as well, but for those who don't know, he's on that side of things. I've kind of stepped in more to the capital formation side, capital raising stuff. Obviously, we're here in Phoenix for Raise Fest, so you do, come in and take care of relationships, speak on the big stages when the lights are bright, of course. But this is something that you really want to speak on. which is accounting considerations for in-house construction. That's a mouthful. I don't really know what this means. I mean, I'm sure I'm due, but if you want to elaborate on this, that'd be cool, because this is something that I don't look at whatsoever.
Yeah, and I'll just touch on your comment about my roles and responsibilities because, basically with overseeing every day-to-day function of the business, I have to dedicate my efforts to what there is most of, right? And so when you go from, just a few years ago or so, we were a much smaller company than where we are now. And
When I joined the company, we were like 200 million.
Was
like
it
220 million or so? It
Yeah.
was, and now we're at 700 basically, right?
So you call it, tripling the portfolio size. That's triple the amount of employees basically. Now there's just a lot more going on. This year we've really built out our HR department, and that I've been spending a ton of time on HR, and we're hiring so many people every single week, and accounting, and so I guess when we talk about my reallocation of focus, it's not just necessarily because I've got a new hobby or a new place that I like to be, right? It's as you grow, more and more of the business just simply becomes operations rather than, let's say, acquisitions and hunting for the next deal, right? It's funny, I talk about this a lot because when you've got no portfolio, the only thing to do is acquisitions, right? So you're underwriting deals, you're talking to brokers, you're touring, you're doing due diligence. And then once you have your first deal, okay, now it's like 50-50, right? You're hunting for new deals, and then you're managing your existing deal. But then, now with 22 properties, it's like all my time is focused on the portfolio, and then there's just a little bit of time needed, because frankly, you don't need to spend a ton of time on acquisitions, especially because Brad does such a fantastic job, and we've got other people now, wink, wink, who are helping us in that department. So
It'll probably be live by the time this comes out, but such is life. We'll wait.
We'll wait. So yeah, that's just my comment about that. It's really out of necessity, not out of interest or hobby. Not to say that I don't enjoy it. I mean, operations is a tremendous challenge, and it's really grown me as a person and as a manager and leader. And Lone Star has really leveled up in the last year as far as how we've just rebuilt the functions of the business from HR, operations, asset management, accounting. But I digress. So we'll talk about in-house construction considerations vis-a-vis accounting. So what's interesting is, this is actually really funny because one of our really great investors that we love, I won't mention his name, but you obviously know him well, from the Bay Area, he was asking about our monthly reports that show a monthly collections chart, or essentially revenue, every single month. And the question was, well, why don't you show the NOI every single month? Because isn't that more accurate, or isn't that more helpful to see, right? And I would, in many ways, agree. I would say, well, yeah, NOI certainly tells you more, perhaps, than what revenue does. But the problem is expenses, when it comes to accounting, are so nebulous. And you can play so many games with expenses because you can take an expense and put it to OpEx. You can put it to replacements, lender replacement reserves, CapEx, in your original CapEx budget. You could do that to cash flow. So, like, for example, I'm sure you've encountered this. An investor might see on our financials like a big negative net income in a certain month. And it's like, whoa, how did we lose $200,000 this month? It's like, well, if you actually look at it, we actually spent, $200,000 on roofs or something.
We were doing our CapEx project.
We were doing our CapEx,
yeah,
right?
that we budgeted and raised for.
Right. So we actually didn't have negative $200,000 of cash flow. We actually raised that money, and it was sitting in the bank, and then we actually financed that CapEx out of equity. So that's just scratching the surface as to how complex and how obfuscated accounting can really be. And so specifically when it comes to CapEx and construction, it's also more difficult when you do work in-house. So for example, we just had an awesome little win on the operations side where we had it was a roof repair that we did on one of our properties, and we got a bid by a third-party construction company. Basically a roofing company came out and they said, yeah, we'll do the job for $30,000. Okay. And we said, thank you very much for the bid. Nothing too wrong with the bid. But because we have scaled up the company and we've been building out these in-house construction capabilities, we now have construction team members on payroll, on the team, that can do that work in-house. And so instead of spending $30,000 on the vendor, we can go to Home Depot and buy $1,500 of materials, and then they can just do the roof repair themselves. Now, of course, their time's not free, right? So their time is something. And
maybe if they're spread thin, we would take the third-party vendor, right?
Exactly, yeah. Because we all know in construction, you have 3 things and you can only choose 2. You've got speed, you've got quality, and you've got cost. Right? So there you go. So in this scenario, we could just take, essentially 10 days to complete the work, no big deal, and we just did the work in-house and saved the property thousands of dollars. So now, when it comes to the accounting of that, it's like, well, okay, I'm going to oversimplify it. Let's say we put the salaries, because those construction guys need to get paid, right? Obviously, they're not doing that work for free, so they need to get paid. So their salaries, let's say we put those salaries onto the payroll line of the property. So now they're like employees of the property. That's going to make the income of the property go down, right? The NOI of the property is actually going to look worse because the property is bearing the expense of their salaries. So you've got income coming in from the tenants, which is rent and other income, application fees, et cetera. Then on the expense side, you've got payroll and repairs, maintenance, and all that stuff. And if we just take those guys and put their salaries on the property, all of a sudden we're showing our investors, yeah, sorry, the property made less income this month. And it's like, oh, that's not good. Well, we did that. We burdened the property with extra expense because we actually saved 20 grand on this construction project. So it's really hard to keep everything straight and really know all the details because you have to see the picture holistically. And it's also a challenge on the accounting side to tell the right story. It's like, well, the right way to do that would be to actually not put their salaries onto the property's OpEx. Those salaries should be booked as, salary, like labor costs, below the line CapEx, right? So their salaries show up below the line, so that's not impacting NOI. And there's some other things that you probably would want to do to make sure that's all accounted for and tells the right story. But I think in a way, doing in-house construction is already very hard. And then when you get involved with these kind of more confusing accounting elements, it can cause a sponsor to think, you know what, I'll just pay the roofing company $30,000. I raised, an extra $1 million in CapEx reserves from my investors. No problem. And it'll just be simple. And then when it comes to the lender, this is where the big headache comes in. Because if you do work in-house, showing a lender, because lenders want to see proof of work and they want to see an invoice and they want to see the payment. And if you're just like, well, I just did the work in-house, it's paradoxically, even though you did it yourself, now it's so much harder to prove. And well, what was the cost of it then? And then the lender's not going to want to reimburse you the $30,000. You get what I'm saying? It's really can be frustrating. So just wanted to share some of the complexities behind the scenes on the accounting side there.
That was actually more interesting than I thought it was going to be honest with you. Because sometimes you get in these subjects and in the weeds, and it's like paint drying might be more entertaining, but that was actually quite informational there and a good breakdown and case study for those who want to know the intricacies of how things work, and then obviously understanding that when there's a big lump sum of payments there, that doesn't necessarily mean that we're losing a bunch of money or there's a problem. It's just, as mentioned, it's part of the CapEx budget. And it's kind of interesting too. Some people, I think smaller shops do capital calls during their investment process, but how we think of a capital call as to how they think of a capital call is different. What do I mean? Well, they basically buy the amount of dollars that it's needed to basically acquire the property, and then this could be like 10 investors together and say, hey, we are going to do renovations. Okay, cool. They're going to get a bunch of bids, not before they do the investment, but after they do it. And then it's, hey, everyone together, we need $10,000. And the 10 investors bring $10,000 there. And they do it in waves like that. And venture capital, when someone does a capital call, that is, hey, we talked about this investment before. Now everyone needs to fund now. That's a capital call. So the word capital call is kind of like a taboo word. It's an unfun, it's like the kiss of death word in what we do in our business, but there's different meetings just based upon how your business is run, the structuring of it. So just wanted to mention that little tidbit there as well. I do want to talk about the James Zhang and Jake Parsons podcast, but I do think we need a visual aid to talk about kind of some of the graphics there. The thing about those two people is they do such great jobs. They have such great visual aids that it would really do justice to wait for that when maybe you're in Colorado. We can do an episode then to really showcase that and break that down. So I think I'm going to skip that for right now. One thing I will talk about is an article that a friend in Austin, Texas sent us with regards to a Wall Street Journal article with regard to basically saying increased landlord-friendly market coming up here. It was basically saying, hey, the kind of time of renters having a lot of leverage, a lot of concessions and whatnot, which we've been talking about here on the show, is starting to end. And it seems like a lot of things, whether it be what those two people have been talking about, Jay Parsons, James Zhang, and what we're saying, what media is catching up to, is literally everything we've been talking about. Not to say we know everything and we're some market whisperer of sorts, but if you've been listening to the show long enough, you know that we are incredibly accurate, and we talk off air all the time, actually. Not to toot our own horns, but things that we've been talking about have really been coming true more often than not recently. So we've been pretty on the money on our predictions.
Yeah, what I will say is, and not to diminish the complexity and the difficultness of staying on top of things, but if you were looking at macro trends, you can kind of predict the future. And you can see what's coming, and you can
you can draw to a conclusion.
You can draw conclusions. You can see the macro trends. But what I will say that's really hard is to get the timing right, because while we've been getting things right and we've been directionally absolutely correct, I totally misjudged how long this process would take, and we're still in the thick of things.
I think it feels long because it's our first time going through something like this, and we live in a world where things we probably like them to move quicker, and we haven't gone through a market cycle yet, technically, in our experience yet in our career. So these things are just slow-moving processes. It's day in and day out because we're in the weeds of it. But if you look back at this or in a different industry and you look into it, this probably looks look a little bit more hasty than how we feel about it.
Well, it's tough too because things happen on different timelines. The stock market, for example, crashed, and now it's more than recovered, and now it's just doing super
all-time
well.
high. S&P 500 is at an all-time high.
Right. So it's been a challenge to be in the real estate industry and seeing that happen, but it was nice to be in the real estate industry. Meanwhile, tech was imploding in 2021, and everyone was
22 as well. I mean, that was at the
22,
low.
yeah.
That was like the 10% dip that the stock market had roughly. That was kind of a window, and if I'm not mistaken, that is when the previous regime, not to get political, kind of changed the terms of a recession. So we probably had a little mini recession. Only time will tell moving forward if that's actually correct or not. But that was kind of a COVID bill, and then arguably with all the kind of short-term debt that was issued before, that's going to come due here coming up. That's something that also might be difficult for kind of the nation to kind of push through there. But just kind of interesting. We've been talking about these macro trends. All of the deliveries coming online, right? Well, obviously, you couldn't buy anything below replacement cost at one point, so then you just build it, right? So there's a massive, massive building spree. And unfortunately, the places that have it the worst are Phoenix, Arizona, Austin, Texas, the Carolinas.
San Antonio, unfortunately, is right there.
Yeah, I mean, I think San Antonio is not as bad. It's just there's not as many people moving to that market as other places. We've been really fortunate that Houston is the bulk of our units and whatnot. And for as big of a city as Houston is, it's actually stayed pretty neutral, which is honestly pretty darn good.
A lot of developers avoided Houston for various reasons, and which has turned out to be a very good thing. And to your point, it's not like developers really oversupplied the San Antonio market. It's just that what supply was delivered to San Antonio was too much to handle considering the demand side of that market, right? Because it's more of a slow and steady Eddie market, not huge population growth. And so when you throw in a bunch of new supply, it's really going to upset it. Austin, its next door neighbor, has unbelievable supply that has come online and is still yet to come. But also the growth is unbelievable in Austin. That's why everyone was so excited to own there, so excited to build there. But the imbalance is overwhelming, right? Like I've always said that you can always oversupply a demand story, right? As much as great as a demand situation could be and people are moving and there's jobs and all that good stuff, all it takes is too many developers to build and it will just totally kill the deal.
Yeah, certainly. So I'm happy that the article is sent to us, and that's just kind of what we've been talking about. We knew at some point that this would change. We knew that over the course of time that this would equalize. Nothing lasts forever in that sense, and this cycle will probably happen again and again and again.
So what is the article saying?
Yeah,
Just
the
for
article is
everyone?
basically saying that the era of falling apartment rents looks to be nearly over. It's kind of the first
That's the
sentence.
headline.
Yeah, well, that's essentially the first sentence there. The headline is technically the article. If you want to look it up, it's a Wall Street Journal article titled, "We're Heading Towards a Landlord-Friendly Era. Expect Higher Rent Prices." The other thing to think about on this subject as well is home prices really haven't moved, but mortgage have doubled, right? So a lot of people can't afford homes right now, and once these units do deliver, there will be an interesting period of time where that rent gap, homeownership affordability to renting, is the biggest spread ever. That will start to shrink and shrink and shrink, right? So that will obviously have pressure on renters, and hopefully have concessions start burning off and whatnot for people who are in our positions. But you drive around many metro cities, doesn't matter if it's Phoenix, Houston, Dallas, you'll see 1 month free or concessions or something like that to entice people to come in.
Yeah, this gap between the cost of renting and homeownership, it has never been wider, and that is causing people to be, it's just causing more demand for multifamily. Let me not ash on my beautiful jacket here. So that's causing people to stay in apartment units rather than leave and buy their house, right? So just to steal a little thunder from James Eng, which is, I know we want to talk about that at some point.
We can mention it right now.
He talked about the earnings calls for some of the largest multifamily real estate investment trusts, which are public companies, so they have quarterly earnings calls to their shareholders. And these companies are talking about how they're seeing their renewal rates just look amazing, because I think Camden or MAA said that they usually see 20% of their residents leave them every year because they're going and buying a house. I question almost if that's true, because I feel like when a tenant's leaving, they might want to check that box and say that's the case, just to kind of be like, yo, I'm leaving because I'm buying a house. I don't know. 20% feels a little high, but they also probably have very A-class properties, so these people are in fact.
This is the kind of the renter base at these nicer units that aren't in the junky 70s, 80s product. These are individuals who...
Renters by choice.
Yeah, this is renters by choice. This is renters that are on the cusp of being able to buy a house.
Right.
They probably have good incomes. They maybe can take out a loan and kind of do that and have their affordability not change too much.
They have the means, and therefore renting for them is dictated by lifestyle, not by income.
Or maybe they're younger. And
that's what I'm saying, by lifestyle.
Yeah,
like they want to be single, they want to be in the city, or
but
they don't have a family yet.
Maybe they're 30 now or 35, and they're done with the apartment lifestyle, and they can finally feel comfortable with where they're at in the career, where they can afford a home, which they were before. Probably not realistic.
Exactly. So if these companies are saying they're typically seeing 20% of their residents leave them every year to buy a home, they're saying it's cut in less than half. So it's less than 10% now, which I totally believe it, and it makes sense. And what that means is there's just more demand for multifamily, which is great, which then helps. That's one element that helps push up rental prices. The other element that's more powerful in this case, that's going to push up rents, is the cessation of new supply coming to the market, right? Because with less new units, there's going to be less competition, and that's going to also push rents up. So, of course, everything has to be in equilibrium. So if right now the gap between renting and home ownership is $1,000 a month, and rents go up a lot, that gap might squeeze down, and maybe interest rates come down as well. So now that gap's further, you have to have some gap, right? Because if it's cheaper to own a home, then your multifamily thesis is not going to work too well. So,
and at one point it was close when the mortgage rates were really low, and call it 2020, end of 2020. That was really compelling. That the story was there, but then obviously what happened? Everyone started to build.
Yeah, it's tough to get it right, but it's interesting to track, and I think that multifamily, like the Wall Street Journal article is saying, is poised to do very well over the next few years or so. However, you and I, we don't invest in an index, right? We invest in particular properties that are in particular markets. So
dollar cost averaged.
You have to dig into the fundamentals of the particular market. And okay, yeah, nationally maybe rents are recovering, but they're not in Austin, they're not in Phoenix, right? So you need to look at the individual market and figure out, okay, what does the supply pipeline look like versus the demand, not just for the market as a whole, but in your submarket, and take that into account when you're doing your underwriting.
Yeah. Final subject, because we have to wrap up and go here pretty quickly. Aura ring. So you have an Aura ring now. You're obsessed with it. You want to tell the people why you love it?
Sure. I'll I'll shout out the Founders Insights because I made a Founders Insights about the Oura Ring recently because I talked about what is measured can be managed and what is measured can be improved upon, right? And so for me and my health, the Oura Ring has been super fun to gamify my health stats. Like sleep is my primary focus, so I'm really pushing myself to get better sleep, to not be addicted to my phone before bed, to have a better wind down routine, to try to reduce stress, to try to get deeper sleep, more deep sleep, more REM. You can see all the data, so it makes it more fun and you're paying more attention to it. It's just the same thing as anything, right? If our goal is to increase our renewal rates at our properties, okay, let's look at our renewal rates every week, every month. Let's obsess over it. Let's think about how do we increase our renewals. Let's host renewal parties. Let's improve our Google reviews for our properties. You know, whatever is measured, whatever is focused on, that's what expands. So, yeah, for me, the Oura Ring, super fun, really enjoying it. Like I said, I'm copying Brian Johnson, following a lot of his stuff, and he talks about how in our society we have this culture that, oh well, I pulled an all-nighter last night working so hard, and I don't need sleep. I function off no sleep, and you know,
that will never be said out of my mouth. I assure you.
right. And instead, you need to flip it on its head, and you need to say, you know what? Actually, I am a professional sleeper, and the most important priority in my life is sleep, and therefore, on my calendar, I have all my most important appointments, like to meet with you, or to have an investor meeting, or to do a best and final call with a broker. Like that's on my calendar, and that's an appointment that I don't want to be late for. But the most important appointment that I don't want to be late for is my sleep appointment,
Yeah,
right?
your bedtime.
Exactly.
Your beloved bedtime.
My beloved bedtime. So that we're changing the culture.
Yes. Well, I love that. I took a nice 30-minute nap today, as you know, followed up with an espresso. So I'm jacked up for this hour. I feel like I'm ready to talk someone's ear off.
What are we about to go do?
Yes, we are about to go to Thea. Very excited for that. Also, if you made it this far, and you're going to the Best Ever conference and you haven't reached out to us and you're a capital allocator, you should reach out to us with regard to setting a meeting with us. Or if you're not going to the event, but you're a capital allocator or an LP investor looking to learn more about Lone Star Capital, my email is always available for you. It is Craig, C-R-A-I-G, @LSCRE.com. But what are we doing? We're going to Thea, the Global Ambassador Hotel, perhaps the best done development of 2024. Like this thing is chef's kiss. It's got some of the best restaurants.
It has a Michelin
Phoenix.
key.
It has a Michelin key, in fact. So I'm not just blowing smoke because I'm a Phoenician and I'm diehard on Phoenix. I love my city. It's great here, by the way, particularly when it's March, or not even March. It's crazy. It is February 19th. And it's been perfect, like absolutely picture perfect. It's been like 70 degrees every day, but super excited for that. We're taking out some dinners. We want to wine and dine you though. If you're an investor, if you're a capital partner, we want to take care of you. We want to show you a good time and give you a little Lone Star flavor and feel. And I'm not talking about flavor just with the food, but the personalities and what we have to offer that might be different than the marketplace options.
We'll be talking about all the secret topics that we can't share on this podcast at dinner tonight.
Yes. The accretive opportunities that we can provide to our awesome people.
That's right.
Yeah,
that's
cool.
Right.
Thank you so much for listening, everyone. We will see you next week. Peace.